Number one advice is always to speak to a mortgage professional. I always argue that it should be a broker, especially with what we're seeing right now.
Why, are you any good? Hey guys, welcome back to season 2 of the Secret Ingredients to Real Estate. We are here 2024 with Jordan from some mortgage company that she's going to tell us about, and Dimitra, my business partner, and we're going to talk about the mortgage landscape for 2024, some predictions, and some new information that any government incentives or whatever. So thank you. And Dimitra, what is your first question?
My first question, obviously there's been a lot of talk about mortgage increases and the rates and all that. So can you give us a little brief explanation as to what's, going to happen in the future, or at least your understanding, and also some notable trends that might be happening in 2024?
Yeah.
Do you remember that question?
I do. I remembered every single prong of it. I got it. I got this. Okay, so starting with, I will say that 2024 is expected to be a year of transition and change and shift, which is, I think, what we all need professionally and for our clients as well. In 2020 to 2022-ish, we were kind of in the thick of the pandemic. 2022 and 23 was like the post-pandemic damages. March 2022 is when we started to see the first increase. So we've been dealing with that. 2024 is where I think we're going to start to see the shift in the downward direction on interest rates. So that's the current projection.
Do you actually think the rates are going to come down? I'm going to play devil's advocate here.
Sure, go.
Because when I'm reading the data out there, so it's like there's a wishful thinking of bankers and realtors saying, okay, rates are going to come down and, market's going to be super busy and it's not going to happen until August. First it was April, it was February.
Right. It was February, then
right?
April,
then April.
June.
And then we're seeing, okay, so last month or numbers went up. So inflation peaked up. So it went from 3.1 to 3.4, 3.4, right?
From November to December.
Right.
No, from November to December, yeah.
Correct.
Yeah.
And then the war got worse in the Middle East, and now we have a Suez Canal issue, and so now these containers are more expensive.
Yep.
I think that inflation is going to go up again.
Yeah.
Because of what's happening in the world, and as a result, our wonderful Bank of Canada is going to say 25 basis points up, as opposed to going down. So. But then, okay, so I'm going to give you a mouthful of what I'm hearing, and then you correct me.
Okay.
And then we are hearing from the Forex guys that the U.S. has to drop their rates. If they don't start dropping their rates, nowhere in the world, no central banks or Europe or Canada can drop their rates because of a currency issue.
Yep, exactly.
So give us a little bit more about that. I'm sorry, I went all economics on you.
You were talking about global affairs.
Yes.
So, of course, that brings in extreme uncertainty and no one can predict. So even with the economist projections, no one can predict what's going to happen because of global affairs, even domestic, but mainly the war that's happening in the Middle East right now and escalating in terms of Western involvement, I would say.
We won't get into
we won't get into the details of that, but it does, it of course, impacts our economy. Right. Now, what I'll say to that is, one thing we've definitely noticed is these increases on interest rates, they take a very long time to make impact, right? So even if there was going to be a quarter point interest rate increase in April or June or even July, the argument would be, wouldn't that be a little bit of a superficial increase? Because it takes, as we've shown, the first increase was March 2022. So it's almost 2 years ago. And we're really only starting to feel the harsh impact of it in the second half of last year and coming into this first half of 2024. Yeah. So what is a quarter point increase going to do this late in the game? We'd have to wait multiple quarter cycles in terms of the economy to see the impact of that.
Okay.
So that's my argument around further increases, because in the last Bank of Canada interest rate announcement, which was January 24th, I believe, last Wednesday, the message has kind of switched around. Now, the Bank of Canada governor has learned his lesson, and he will never explicitly...
You think so?
He learned his lesson in terms of communication and how he communicates his projections.
Yes.
Because in the beginning of the pandemic, you'll remember that he's the one who explicitly stated he only expects 6 quarter point increases, a slow grow on interest rates, which obviously didn't happen. And a lot of people took variable terms based on his explicit advice. So now he's really avoiding saying anything around projections. He continues to say he'll keep the chances of increases on the table, because if inflation increases, then we're going to see interest rates increase is what he's saying.
A little PR support never
hurt anybody.
Right?
Yeah, he needs some heavy lessons in PR. But so to that point, oh my gosh, I lost my train of thought.
It's okay. It's a great discussion.
Okay, well, I wasn't done that point though around the Bank of Canada making just kind of around the messaging.
Yes.
Shifting from how high the interest rate can get to how long the interest rate's going to stay this high. So it's not how high, it's more like how long can we sustain this peak interest rate. I don't think we need to see further increases. It's more about like the damage is going to be done and how much longer we keep these interest rates this high, because for 6 months, people can pull out of their savings to make these extra mortgage payments, these gas payments.
That's if they've been saving.
If they've been saving, but even beyond savings, it's credit cards too, right? People are going into lines of credit cards, but eventually those get maxed out as well. So it's about the sustainability of how long we can hold these interest rates. I don't think increases are really going to be the thing that makes or breaks us. It's how long, because if this, most economists after the announcements we've seen are that the average economist assumes we'll see our first decrease in April or in June of this year. So that's the bet as of right now. That can change.
Promising and optimistic, right?
Yeah, for sure.
So that's good for first-time home buyers, right?
Yeah.
And anybody else that's kind of refinancing or, considering purchasing a second property. Now, what factors should a potential home buyer consider when they're sort of embarking into the journey of a mortgage application?
There's so many things to consider, especially right now with us being in this shifting market. I think on your side as well too, right? The housing market is expected to shift along with interest rates. That'll kind of come hand in hand. Number one advice is always to speak to a mortgage professional. I always argue that it should be a broker, especially with what we're seeing right now.
Why, are you any good?
I mean, I'm plugging myself, but also any other broker over banker, because I can speak to that experience having been on the broker side and on the banker side. And the reason I say that particularly right now is you need the options.
Yeah.
Clients are rate shopping more than ever. Rates really, really matter. Payments really matter to clients. So having those options, and not every client can afford with your big banks right now.
I used to be a big cheerleader of just working with the bank. If you bank with RBC, go with RBC. If you bank with Scotia, go to Scotia. So I used to always be like, wherever you bank, go. But over the years, like 20 years of experience now, I think brokers are it, because last night I was with my friends at the cigar lounge, and there was one manager from a certain bank, and I'm gonna say the bank. I almost said it. It's like it's almost like Trudeau calling a ceasefire. But yeah, you like controversy, don't you?
It's not gonna be a
but he said, the banker says that the banks are like 100% expecting the first rate drop of at least 25 basis points in April. The next announcement is April, right? So they want this to happen.
The next announcement is in 6 weeks, so it's actually
March.
So and then April.
So probably March is going to be stable, and April is the next drop, and then it's going to stay. Because they need the market to fuel. They need the money, right? RSP season is over, right? Everybody needs to put their RSP money in, and then they need to go get mortgages. That's how the banking system works. It's like January to March, let's get everybody to put their RSP money in, and then March to June, July, we need mortgage, we need money, right?
Yeah, they need credit.
So they need credit. So that's going to happen.
Yep.
And then it's just going to slow down, right?
Well, okay, my argument to that would be around the fact that the Bank of Canada also has to consider, there are a lot of people that purchased in 2020 to 2023, especially in variable term mortgages, who are impacted today, or not even a variable term mortgage. They just had to take interest rates at 5 to 6% if you purchase in the last 12-ish months. What's not being considered in a statement like that is the renewals that are coming up in 2024 and 2025.
But most of those people who are going to renew, there's people who like I'm going to cut you off. I love you for this.
I'm ready. It's not the first time meeting you, Sherif.
Yes. So we have fixed rates, we have variable rates. Everybody's watching so like they're just staring at the variable rates. Where are those rates? But then no one's actually looking at the 5-year bond yield rate, right? Which is dropping, which is allowing people to get into fixed mortgages at 4.99.
Okay. Yeah, I hear you. Okay, so what I like to say about that point, and it's funny because you sound exactly like my client, so I love this. I live for this, is because everyone gets attracted by this extremely low interest rate, the lowest interest rate on the market, which is always going to be your 5-year fix.
Yeah.
But you have to think.
Really?
the longer the fixed term, it'll be typically the lower the interest rate, especially right now.
Okay.
Right now in particular, because what you have to look at is the bank as a business. The bank is ultimately a business first, unfortunately.
Yes.
Most people don't recognize
I think people recognize
but
that.
it is
Yeah.
a business first, right? So if they're selling you those 3 and 4 and 5 year fixed rates at a discount, they know what they're doing, right? They know that they're incentivizing you to take that lower upfront interest rate today because they know in less than 2 years, interest rates will have significantly gone down. But unfortunately for you, you've locked in.
Right.
You've locked into 5 or 6% because it was attractive at the time to you, which is fine. It makes sense for some people, but the problem is now you're locked in. When interest rates head in the downward direction and your penalty on a fixed term is based on interest rate differential, your penalty to break that mortgage, tens of thousands, even 6 figures. I've seen penalties that are above $100,000 to break a mortgage because of the spread, right?
No,
and when we know so Bank of Canada right now, like the projection on Bank of Canada interest rate is that in the next 2 years, we should see somewhere to 2 to 2.5% of a decrease on the overnight rate. So on prime rate, that's how it impacts variable term mortgages.
Okay.
The question is when and how much does it is it going to be quarter point decreases starting April consistently? Is it going to be like 25 and then 50? You know, how quickly is that going to happen? And when is it going to happen is the question that is outstanding. But it is going to be, it's expected to be anywhere between 2 to 2.5%. So a really steep discount. So when you consider that, it really makes those 3, 4, and 5 year fixed that are attractive today, because maybe they're 0.5 to 1% lower than your short terms or your variables today. You have to look at it the long term, look beyond the 2 years, the 3 years, and does that really make sense to choose that term up front?
That's always the hard,
right?
It's like a toss up.
Exactly. And we go,
sure.
every client needs to go, we need to do an assessment because the advice is customizable to the client because maybe cash flow is their biggest concern. So if cash flow is your biggest concern, take that 5 year, take that 3 year fix, take that 4 year fix. And I'd probably go 3 year fix as the longest term on a fixed term. I wouldn't go 4 or 5, but it might make sense to take the 3 year fix because one, when you have the lower upfront interest rate, your payments will be lower, so helpful with cash flow, but it also helps with affordability. And I don't think a lot of clients or even realtors or mortgage professionals realize that.
Can you say that again then?
Yes. The lower your upfront interest rate, the higher you can actually qualify for. So let's say that the variable rate today, let's say it's around 6.5%.
Yeah.
And there's so many pros to the variable, but the 3 year fix today, let's say it's 5.5. So a 1% difference between the two. If you're going to take the 3 year fix, the stress test means that we qualify you at 2% higher than the actual interest rate you're getting. Okay?
Okay.
So we qualify you at 2% higher. So if you're taking the 3 year fix at 5.5, we're qualifying you as if your interest rate's at 7.5. Yes. If you're taking your 5 year variable at 6.5 and then add 2%, we're qualifying you at 8.5%.
Okay.
So that additional percent makes a huge difference on qualification and affordability. So for the right client, it could absolutely make sense to go with a fixed term if they need to increase their affordability slightly to get into the market.
Smartest broker I know.
Well, she has a lot of insights, right? Working every day with buyers and borrowers. So you'll say those mortgage rates, variable versus fixed, it does impact the borrower's decisions moving forward. How, in your estimate, what's the difference from, let's say, a year or 2 years ago?
In terms of what? What's the difference
The changes in the market and
the changes in the mortgage interest rate market.
Yes.
So what we're seeing in the last year is we've seen fixed rates starting in about November, I'd say October, November of 2023. We started to see fixed rates start to go down, and that's to the bond yields because fixed rates are priced based on where the bond yields are. The variable terms, we've started to see banks actually increase the discount against prime because they want less people to take the variable because now we know we're at the finish line of this height of interest rate, like the peak of interest rates. So they don't want you to take the variable.
Okay.
Because they know like they're going to just start, the bank is a business. They're going to start losing money effectively in these, whatever, April, June, as soon as interest rates start coming down, they're making less on interest. Why would they incentivize you to take something when they know they're going to start making less money on it this year? A sweet spot would, to me, it's the 5 year variable because when you compare the 2 year fix, high interest rate today, and 2 year fix is kind of your sweet spot if you're going to take any fixed term.
Okay. 2 year fixed is the sweet spot.
Yeah, because
but those rates are massively
Higher.
They're like 7
yes.
point
They're
something.
like in the mid 6%, and that's
I can't
exactly.
believe we're saying 6%
I
and
know.
7%. Like
I
in
know.
20 years, I haven't. Well, you
I-
maybe are like, what, Sherif, 18%?
It's offensive, but
What's
okay.
the highest you've ever paid for a mortgage?
22.5.
Holy shizzy.
No.
In the 80s, yes.
But I mean, was your mortgage like
It was
100K, 50K, $50,000?
yeah, it was around 50,000.
Yeah.
But in
Different.
those days, the
income,
salaries,
yeah.
the money we used to make,
It was
was
relative.
nothing. Like you
Yeah.
make 25,000 annual, gross, right?
Yeah.
So
Wow. Yeah.
it's huge. You used to,
That's crazy.
yeah, you get a car for 19% and a house and a condo
credit
for
card.
22.5, and then it's like, okay,
Are
now,
you
now how
kidding?
do I eat, right? So no, that was our reality for a very short period of time, but
Yeah,
it
that
did
was just the
happen.
norm.
Right, yeah, but it just happened, and we all survived it, and we're here today, right? And I
Yeah.
think we're going to survive, and the
Yeah.
public is going to survive this. The consumer is going to survive this little blip in our economy, and life goes on, as they say,
Well,
right?
that's genuinely the shocking fact. Like everyone is still holding out, expecting defaults to take this massive increase on cars, on homes, and it's not happening.
Yeah.
There's been a slight uptick, but
Yes.
in historic levels, like it's not happening. There's no huge boom on defaults, which is
Right.
which is astounding considering. I wish I could show a visual right now, because I actually had a client ask me a question, as I do that chat of kind of what terms I would suggest between the fixed terms, the variable. When I was kind of mentioning the variable as the preferred rate and term right now, they asked me a question that was a great question to ask, which was, right now is prime at a historic high? Like, can prime get any higher? Because their fear is that prime can go much higher. So I pulled up a chart to show them what prime has been in the last 10 years. And it's crazy because before the pandemic, we were floating between 3 and 4% maximum on prime. We're sitting at 7.2 today.
Holy.
And so that's like in the last 14 years.
Yeah.
So it's very, very high, relatively speaking. To assume a 2 to 2.5% decrease on the way back down is very normal. I don't think that's because you were asking in the beginning, like you're playing devil's advocate, is that really going to happen considering the global affairs and situation? Yeah. I do believe it has to happen to protect our own domestic economy. And just to finish my point, I think I was mentioning earlier around the renewals that are coming up. I think it's like $254 billion in 2024 and something around $352 billion in 2025.
Okay.
That's a lot of money. So what the Bank of Canada has to consider really greatly, and has to be on the forefront of their mind right now, is it's all fine when you've impacted us in the last 3 years, but now you're taking another several hundred billion in 2024 that's going to be impacted by, right now we're still sitting at the 6% interest rates, 5-6% interest rates. And then if it waits till 2025, that's another few hundred billion that's impacted, and that's going to really mess up our economy. Like they
Canadian
can't afford.
banks are not like the U.S. banks. The U.S. banks are in real estate. They don't mind holding the property and doing their foreclosures and short sales. Canadian banks do not want these properties. They don't want to hold on to any real estate. And frankly speaking, who wants to see families hurt into these power of sale situations, right?
No, there's a very real part.
There's an impact here.
Yeah.
And it's election year, so everything's happening.
And that's the thing that I didn't bring up.
So
exactly.
we have the U.S. elections. We have Canadian elections
Next year.
Next year. So,
but if the U.S. elections are coming into the point that you made about the U.S. dollar and like foreign exchange and the Canadian dollar as it compares to the U.S. dollar, if the U.S. dollar is going to start decreasing this year because of the 2024 elections, you can be sure that we're right behind them.
Yeah.
So I think the elections strongly work in our favor, especially because ours is right around the corner too. So that's going to be great.
Okay, all right.
So we're gonna stop for a short break, but before we
Yes.
take this break, do you have any questions? I have a question. I have always a burning question.
Okay,
but we'll go for Dimitra's question.
Okay, my question is, with all this upheaval and everything, right? Are there any programs or incentives for first-time home buyers specific to mortgages from the government, provincial or federal?
Yeah. No, there's a few.
We'll be back after the messages.
Hang tight to find out.
Yeah, we'll be right back, and then we can answer those questions. Thank you, guys.
Okay.
All right, awesome.
Thank you.